Hello, welcome back. I'm joined again with Jose Vasquez, the CEO over at OIIIF Mining. We spoke back in June in Quebec, and this time we're in Colorado at the Precious Metals Summit here in Beaver Creek. So, Jose, good to see you again.
Thank you for having us.
Just a quick overview for those who potentially might not have seen the video before or less familiar, just overview of the company, if you don't mind.
Yeah, we are a gold developer in Quebec, particularly in Val-d'Or, a project that has already a pre-feasibility study, and we're really focused in developing this asset called Marban.
Awesome. Okay. Obviously, since we last met, like I said, you've just released a pre-feasibility study.
Correct.
Run us through the numbers. What's it look like?
So we have a net present value of $463 million, 23.2% IRR, and levered, if we actually use that, is 44%. And we have a production profile of 161,000 ounces for 10 years at the moment.
Okay. And how's this looking in, what's the sort of all-in sustaining costs and what?
Yeah, the all-in sustaining cost is around $882 per ounce,
okay,
which is super competitive, and that is particularly because we are in Val-d'Or where there is a lot of infrastructure.
Okay, awesome. Okay, I'm just trying to get my head around what the next steps are. Obviously, you've got this PFS now.
Yeah.
How do you create more value here?
I'm really excited on that question. We'll create value by fundamental values. So we are moving the pre-feasibility to a feasibility study by next July. But as we do that, we are increasing the resources around where we are working, moving them from what we call potential economic mineralization to inferred resources. What that will do is that for every 160,000 ounces more that we find, we'll add an extra $100 million to our current NPV. So let's say that, for example, we come up with 640,000 ounces being found, well, that will represent another $400 million into the net present value. And that is right now our target. We're spending 80% of our budget doing that, 20% of our budget trying to find a new discovery in our greenfield area of Marban.
So how are you doing that in terms of the 80% of the budget? Is that mainly just infill of the existing resource, or are you looking sort of long strike at depth? How are you going to
We are currently not doing more infill for measured and indicated, but rather converting what we call potential economic mineralization, which means areas where we have been drilling them at 90 meters apart,
right,
converting that to inferred resources. So from that point on, it is very obvious that we'll continue to convert, but we don't have to worry about right now because that's going to be money that will go after year 10. So that's why we're focusing on this idea of converting into inferred resources in a short period of time.
Okay, awesome. And how long are we looking at potentially doing that? How long is this drill program, and how much budget are you allocating to this?
We have allocated a budget of around $20 million from now until finalizing the feasibility study. And the idea will be to effectively put a new resource by the first quarter of 2023, explaining the expansion of Marban.
Okay, so drill rigs, are they up and running at the moment?
We have 3 drill rigs right now up and running.
Okay, and let's look a bit more at this 20% that you're looking at exploration, sort of more regionally. What excites you about that? Why have you decided to go there?
Yeah, we have 3 main faults that actually cross through the property that goes from the northwestern side to the southeastern side. That same structure goes into Kina, where they have been finding a lot of mineralization at Wesdome. It's the same trend where we have Marban, Quirenza, and Malarctic. What we will be doing is fences every 400 meters, trying to hit some other Marban in the region.
Okay, and would the idea be that if you were to find another sizable deposit, that would just act as a satellite to your existing?
Correct. I mean, the whole idea is that the plant will be sort of in the center of gravity.
Yep.
Something that I should mention is right now our capex is $435 million. If we manage to work together with Canadian Malarctic, which is only 12 kilometers from where we are, and evaluate the opportunity of doing a toll milling, our capital expenditures reduces from $435 to $160 million. Wow. We're still refining those numbers, but that's approximately where we get.
Can you go into a bit more detail on that? Because that sounds very exciting and obviously changes the whole scope of this project, yeah, potentially. So they're 12 kilometers away.
Yes.
What stage of development are they at, and what's the sort of scale of their resource? How likely are they permitted?
So Canadian Malarctic actually is the largest gold producer in Canada. They are going to be running out of ore by 2027, 2028, based on their own information from the pit. So then the capacity that they have in their mill will have excess of capacity. So it makes sense, in a sense, for them to actually buy the ore from us or charges for the toll milling in a toll milling agreement. If we manage now not to invest in that infrastructure in our own project as a standalone project, then our capital expenditure is reduced from $435 million to $160 million.
What could that do to your actual all-in sustaining cost, though? Obviously, having to then track it somewhere else, and I assume you'd be selling it.
It probably will increase a little bit, but the most important thing is that you will impact less the area. From an ESG perspective, will be fantastic, and the NPV will raise. But more important, the IRR will go to the roof. The payback is not in 3.5 years, but actually in 8 months. So there's a lot of synergies that could be exploited by working collaboratively.
And how have you had discussions with the company about this? Is this something that is pretty realistic in terms of what they need and what you need?
Well, it's something that we will have to address as we go. I mean, something that it is certainly in our own interest. No?
Okay. And then just sort of looking at the wider portfolio, obviously I know we touched on this before, but it's still mind-boggling to me that obviously you've got so much exposure to Moneta, and which is a world-class asset. So I think they just released a PEA which looked pretty outstanding. So could you just remind us of sort of your strategic investments in the other companies?
Correct. We have 2 strategic investments. One that was built in Ontario with our project Garrison. We put it together with Moneta Gold. Moneta has right now, between Garrison that used to be OIIIF and Moneta, around 11 million ounces. OIIIF had a PEA for $300 million. Moneta had a PEA for them for $400 million. And it really shows how much value was created by putting it together, because now the combined PEA actually shows $1 billion in net present value. That represents into our portfolio 24%. We have, as OIIIF Mining, 24% of Moneta Gold, which is exceptional. And in the case of Cartier, happened something very similar. We had the property around the main deposit of Cartier, and we believe that by putting it together, Cartier will have the opportunity to do regional exploration and to really show the potential that exists for other ore shoots similar to the one that Mr. Philippe Cotier was able to found.
So at the moment, in terms of your market cap, it's around the 100 million mark. What's the value of the strategic investments that you own at the moment?
It's around $46 million between both. Yep. We have right now in the order of $60 million in investments, which is these 2. Plus we have in the order of $28 million in hard dollars. No?
Okay, so in terms of the actual, if you sort of take all of that aside, what does that leave the value of the asset that you have at the moment?
Well, that's a good question. We have $100 million market cap with $88 million in cash. So that means that effectively the enterprise value of the company is around $12 million.
Right, okay.
And we have over 3 million ounces in the ground, which means that you're essentially buying cash and having the upside on having a mine in Val-d'Or, in the best jurisdiction in the world, 12 kilometers from the most important gold mine in Canada, for nothing. Yeah. So, but this is the market, and we have to continue working with it, and we have to continue doing the proper engineering work, and at some point the market will react on that.
Yeah, let's talk about how the next 12 months looks, and sort of how you're going to be sort of increasing to add value here. What can we look out for?
Drilling around the current area, which again, for every 161,000 ounces that we find, represents $100 million in the net present value, having a new resource for the first quarter of 2023, and finally in July 2023, the feasibility study, for which we really intend to have the financing package behind that. So it will be the fees with a financing package, so our investors could understand that this is really manageable and something that is doable, and we can either go on a standalone basis or going through toll milling, which will be much more efficient, much better for the region in general.
Brilliant. Jose, thank you for your time.
Great. Thank you so much for your time.